So instead of Tesla shares sitting in your brokerage account at Fidelity and you can't really do too much with it, I can convert them into tokenized shares. Same rights, same governance, same economic interest, because they're simply shares sitting in my MetaMask wallet or my Exodus wallet. But now I can do something in DeFi with them. Right? I can borrow and lend more easily against those assets. So again, I can make more money with my money. I want to use the tokenized version of that.
Securitize's mission is to tokenize the world. With over 4 billion in AUM, they're the world's leader in tokenizing real-world assets, working with BlackRock, Apollo, Hamilton Lane, and VanEck on fund structures, and more recently partnered with the New York Stock Exchange to tokenize stocks. My guest today is Duke Kim, Director of Institutional Solutions for Securitize Fund Services. Duke's focus is to represent Securitize platform solutions across fund administration, real-world assets tokenization, and transfer agents. And Duke has grown into a thought leader in real-world assets tokenization and is regularly invited as a speaker at crypto conferences such as the Digital Assets Yield Summit, Crypto Finance Forum, and Cayman Crypto Week. When a fund manager like BlackRock or Apollo comes to Securitize and says, "We want to tokenize our fund," what problem are you actually trying to solve?
My cheeky answer is that the first problem that it helps managers, traditional managers, solve.
Welcome to the Accountant Quits podcast, where we help accounting and finance professionals learn how to manage a business using crypto. On this episode with Duke, we discuss tokenization through Securitize, the New York Stock Exchange partnership, the tech stack for tokenization, Onchain vaults, and more. The Accountant Quits is the official podcast of the Onchain Finance Institute, the leading educational provider for finance teams using digital assets. Their programs, the Crypto Accounting Academy and Crypto Treasury Management Academy, focus on practical knowledge, including tools required to work with digital assets. Inside their platform, you can connect with peers working in Web3, join focused chat groups, access job opportunities, and attend practical workshops on on-chain finance. You can join the community for free by heading to Onchain Finance Institute. The link is also in the show notes. Now let's get into my conversation with Duke. Duke, welcome, and thanks for making the time to be here.
Umar, thank you so much for having me. It was a pleasure to finally meet you last month in New York during Digital Asset Summit and to continue on the relationship across both companies here.
It's a pleasure to have you here, Duke. Before we dive into Securitize and tokenization, I always like to start with the origin story of the guests. So you've been in the crypto industry since 2018, starting at Luca, where Luca, they provide crypto data to enterprises. Then you went on to Legible, a crypto subledger, followed by The Block. The Block is all about crypto news and research. And for the past year and a half, like I mentioned earlier, you've been at Securitize, sitting at what argue is right now one of the most consequential intersections in finance, bringing traditional assets on chain. Can you walk us through that journey? And what was it about real-world assets tokenization that made you want to move to Securitize?
Absolutely. So I always joke that it was really a series of misfortunate, career missteps that got me here. But my traditional background comes from Wall Street. So I was a derivatives trader, a corporate bond trader through the global financial crisis. So I sat, at the real forefront of capital markets pre-crypto, right? At that time during the crisis is when Bitcoin was born. And that's when I started, reading about it, thinking about it, trying to get my head wrapped around this asset that came out of electricity and compute, right? And then it wasn't a corporate bond, it wasn't currency, or what is the thing? So it's always been in the back of my mind when I was on Wall Street. Post sell side trading for a number of years, got into consulting, was at Bloomberg for a number of years as a relationship manager. And that's when I think stepped foot into Bloomberg, which is a great company, right? Has done a lot of good for traditional finance, takes care of their employees, great place to work. At the same time, I remember walking into my first day, a friend of a friend, I get introduced to, and he looks at me and he says, "Welcome aboard, Duke. This is the best place to be, especially for all Wall Street guys. They'll never fire you." And I realized then that I have to leave because I was just too young to die there. And I think my first startup, I was in my mid 30s when I finally took that plunge. But I just realized I needed something that would teach me every day. You know, on Wall Street, you make good money, you make some great friends, a lot of good stories, but at the same time, you're not really learning anything on a day-to-day basis. And then also, you're really just one cog in a broader machine where you don't really have an impact on that industry, good or bad, you know, ideally. That was, you know, the impetus broadly for why I got into crypto was just that I wanted to learn, wanted to be at a place that was really making an impact somewhere in capital markets. You know, this has been my entire career, and I think crypto broadly before it became digital assets was that opportunity. Specific to tokenization, when I was at Legible, this was kind of tokenization round one, right in the early 20s. We were trying to sell the subledger, the tax software for platforms that were tokenizing assets. So originally, tokenization was something for me to sell into, and then on the back of that, from a reporting perspective, and on the back of that, I really started to understand the unlock that tokenization offered, both from what I call front of house, right, from an investor experience perspective. So you have, like many people that enjoy crypto and digital assets, right, you have the concepts of self-sovereignty, of not trusting an institution saying, Umar, you have $100 in your Chase bank account. Well, now you have it in your wallet. You control that. No one else can take that from you. But also then from the back of house impacts as well when you think about tokenized deposits, instantaneous final settlement. So now you have no worry of trade failure from like a DVP, RVP, delivery versus receipt, you know, just trade flows, right? You have atomic swap settlement, no trade failure. You make it much more efficient, and you ultimately unlock capital on bank balance sheets. They actually, post the financial crisis, all the major banks and brokers have to hold a tremendous amount of idle cash that does nothing, right? Just to support. We do a big trade, you forget the trade. I'm out money. I'm waiting for securities to be delivered. When you have tokenized assets that are, you know, running on blockchain rails, all of those problems go away, and that capital can also be unlocked for the banks. So there's again both a back of house tremendous capital unlock and also a front of house investor benefit to tokenized assets. And the two combined, you know, leverage on my background and my experience, but also because the space moves so quickly and there's so many people innovating, really give me an opportunity to both learn and also have an impact on the space.
Thanks sharing. Now, like I mentioned in the intro, Securitize, you guys provide the infrastructure for tokenizing financial assets on chain, covering the full life cycle from issuance and trading to compliance. Securitize currently has 4.5 billion in tokenized assets, working with institutions like BlackRock, VanEck, and Apollo. BlackRock's Beryl alone is the largest tokenized treasury fund in the world right now, with over 2 billion in AUM. So, in short, Securitize, for the listeners, it's a regulated infrastructure that lets the world's biggest asset managers bring their products onto blockchain, right? Now, I want to start with the business case of this. When a fund manager like BlackRock or Apollo comes to Securitize and says, we want to tokenize our fund, what problem are you actually trying to solve? And maybe if you can walk us through what Securitize will then do in practice to make that happen.
Sure. Great question, Umar. My cheeky answer is that the first problem that it helps managers, traditional managers, solve is really maintaining relevance, right? As more and more you know, we talk about it here in the States, right? This multi-trillion-dollar silver tsunami, this great wealth transfer. There are more investors that are really operating on chain, right? Again, if you are, you know, significantly younger than me, you also have just more inherent distrust of the man, of the machine, right? You've seen these big problems through the financial crisis of we thought we were entrusting our money, our retirement into this thing. And because of reapplication, because of malfeasance, all these other problems that have occurred, right? These younger and younger investors are, you know, want to hold their own assets, right? Really control their own destiny, but also invest and think about risk management differently. You fast forward a bit to COVID and the Wall Street bets era, right? Where a lot of people were again realizing I'm never going to be able to retire or buy a home because I only make $45,000 a year, right? These same salaries are what I got paid, you know, 25 years ago. they needed to maybe take some more risk, maybe think outside of the box when it comes to investing in the opportunities. So I think tokenization is, a solution to, again, traditional managers thinking about how they appeal to younger generations. When Franklin Templeton released Benji originally, Legible was in the background as the reporting partner for them, right? And the concept from their team, in my words only, right, was that they needed a way to, again, appeal to and attract younger investors and maintain, again, that sense of relevancy. The other piece then, from what we have brought, like you said, we are a fully regulated capital markets infrastructure for managers that want to come on chain. As I talk to new managers that are fast follows behind BlackRock, again, the cheeky answer is we've already survived diligence by some of the largest issuers, custodians in the marketplace. I can survive yours. Like, we will survive yours. We have all of that put in place now, and we're doing that at 4.5 billion is a big number, but in the grand scheme of things, when you talk about total equity markets, total real estate markets, right, it's still a very large scale proof of concept conversation. So very early innings, right? But when you think about where the size of some of our products have gotten to, I think where we sit, we have launched over the last 7 or 8 years about 30-ish tokenized products with great managers, and we'll call it, pretty strong managers as well, just not obviously controlling the same amount of capital that someone like BlackRock does. But 7 or 8 of those products are over $100 million in AUM. Again, small when you think of the overall size of that manager, but at 100 to $200 million in AUM, the proof of concept experiment starts paying for itself, right? You're covering the cost of tokenization, the cost of updating operational workflows, going through the diligence process to onboard us as your vendor, right? So we have now, again, proof of concept or really first product launches with these managers that can pay for itself. And I think that's also important when people think about bringing this business case to the rest of management, right? So we have a number of conversations in flight now with leading issuers globally. They're trying to obviously understand what is the thing, right? What are the regulatory risks? What are the things that we're not considering from a risk and control framework perspective? We love answering all those questions. And then we can also say, look, if this thing is successful, and we obviously want it to be successful, we have distribution, we have registered representatives that can sell tokenized fund products. We have an incredibly active DeFi team that really helps drive utility for these security tokens, right? Going out to protocols and lending platforms and saying, hey, Umar and I are about to bring XYZ type of product. This is the yield profile. This is the underlying. Would you think you have market makers or lenders against those assets, right? So we really try to solve or at least have answers for the demand side of the equation. And then obviously the supply side of the equation comes from working with really, really great managers. The thing that it doesn't solve is maybe a better question. So when we think of all the would-be emerging managers, I have this crazy idea and I want to tokenize it because I think it solves distribution. My thought is always that if you can't find money from your rich dentist next door off chain, you're not going to find a lot of capital on chain, right? Thinking back to the NFT boom in the early 20s, my CPA had actually reached out. He's an amateur photographer. It's like, hey Duke, I know you're really big in the NFT space. You seems like you're having a lot of fun. You're making some money. You're trading all these, monkey JPEGs. I have all these great pictures on my iPhone. I would love to make NFTs and make money off the thing. I told him, well, if you can't sell them on Etsy or some art platform, you're not going to sell them on OpenSea. Like, there is not going to be, the on-chain investor is really just a subset of the off-chain investor.
And like on paper, because they're now sitting on the blockchain, they're supposed to be faster, cheaper, more portable, programmable. But what's like the feedback that you've received from these asset managers that have dabbled into tokenized funds, asset managers, and maybe investors as well?
Yeah, so going back to the way I had opened it with a front of house, back of house kind of bifurcation, right? I think Securitize and the tier one tokenization platforms that compete alongside of us have created some of the solution for front of house benefits, right? Again, adding utility to the security token, again, migrating, we'll call them traditional capital markets workflow, primitives, right? So borrowing and lending. right? So when you think of even folks like if you have a Fidelity account and you have your 401k or your brokerage sitting there, you can borrow against those assets. You can offer them out for lending. It's a complicated workflow. You got to click a lot of buttons. A lot of people don't realize this. I was sitting in on a panel with the team from Robinhood during Digital Asset Summit, and they started talking about, again, the use case for being able to more easily allow their investors to lend against their assets or to borrow against their assets, right? That's what DeFi unlocks for tokenized assets. So when you have tokenized money market fund, tokenized private credit from Apollo, right? The concept is looping, which is just a fancy term for prime brokerage on chain, right? You have an invested asset that you have put capital into. You can now borrow against that asset to reinvest back into that product or do something else with it. Much more easily, still compliantly in the way we build the world, you have that front of house use case to allow investors to make money with their money, right? That's not just reserved for the ultra wealthy that have $100 million in their brokerage account or $10 million in their brokerage account. You can do this with 1,000, right? Just through the magic of DeFi. It makes that easier. Where I think we're all still trying to build and support is a lot of those back of house benefits. I was talking to a pretty large real estate group the other week, and again, they were very quickly starting to just go through how much money can we make off the thing? Where can we save money in this thing? Said, well, here's where you can make money from by driving AUM because those tokenized assets versus kind of the paper analogs are more easily used in DeFi. They should be more attractive to the investor. And so that'll drive AUM there, and which ultimately drives fees and performance and all that stuff. The back of house questions were rapid fire to me. It's like, what can we get rid of if we have a tokenized asset? Do we need fund administration? Do we need, capital statements being sent over email? That stuff is still being fleshed out. You still need a fund administrator. You still need an auditor. You still need a formation attorney. You still need valuation experts if you're dealing with illiquid level two, level three assets. You still need all of that infrastructure because at the end of the day, we're still living in mostly a paper world, right? You're still living in an analog world for capital markets. You still need all those things. So that's still being fleshed out. Again, at the end of last year, there was a really big conversation. A couple of major banks and providers had started working on tokenized deposits, right? And again, that concept, when you have tokenized deposits running on blockchain rails, you start unlocking at an institutional level capital efficiency because you're not worrying about settlement risk, right? Ultimately, there will have to be a change where the banks can unlock some of that reserve capital so they can do other stuff. And so there's less of a cash drag on the balance sheet. That's still to be delivered, to be seen in terms of when we'll get those things. Where we are a little bit faster is in cap table management, right? Because it's in a blockchain, it can be more transparent. Some things have sped up a little bit, right? Again, with trade settlement, OTC for digital assets, some of those things have also sped up, but I don't think the benefits are solidly quantifiable yet and really, needle moving just yet.
All right. Now, to summarize for the listeners, Securitize is the fund operator and tokenization infrastructure provider, while BlackRock, Apollo, VanEck, they are the investment managers, right? So I want to ask you, what is it that Securitize does not do in this process?
Yeah, so great question. And we don't always have to be the sub-advisor. So there are multiple flavors of tokenization, still dealing with taking a security, making a digital asset security. But in terms of the flavor of tokenization underneath that, whether it's tokenizing a full master fund, so BlackRock Biddle, net new product from BlackRock, right? We've tokenized the master. We've often done feeder fund tokenization that rolls into an existing paper master. That's the Apollo product as a great example, right? So the Apollo diversified credit product is, I think, 20 years of history, $1.5 billion in AUM. About this time last year, we tokenized a feeder fund into that master fund, and that sits at about a tenth of AUM, so about $150 million. Again, the reason why investors may opt to subscribe or invest into the tokenized feeder is because investors can more easily borrow and lend against those assets in the world of DeFi, right? So again, going back to the looping concept. So broadly, though, we try to mirror the paper analog workflow, the capital markets primitives, moving them on DeFi, moving them on blockchain rails. The thing that is still amiss, and again, and if I had my druthers and I ran Securitize and, Carlos reported to me rather than the other way around, I would think custody, or I do think custody is the thing that we don't do yet, and the thing that is missing. So if you are thinking about tokenized equity or even tokenized fund shares, right? You go through our KYC AML process. If you're investing or subscribing via stable coins or digital assets, right, we do all of the compliance checks on the wallet, on the transaction, all of the normal things that would be expected from a screening perspective. At the end of that onboarding and subscription journey, though, the investor receives tokens instead of a claim that's held against DTC, against assets that are in some segregated or omnibus account sitting in your brokerage. Not exactly sure how that flow works, right? Someone else is holding your assets, right? And for the most part, that's fine. When you think about tokenized assets, you can work with a custodian like a Coinbase Prime, Anchorage, BitGo, to hold these tokenized assets. Most of our investors we've seen actually prefer self-custody because it again more easily enables the DeFi use cases that we talked about. So short story long though, we don't have custody, right? And I think that is what is, and maybe I think this is a follow-up question on your side, right? That it drives us to where the sort of analog breaks, or where does the analogy break here. Right now the answer, the thing that we don't do is custody of investor assets.
Very clear. Now, I was looking at the AUM of Securitize on DeFi Llama, and I saw that number grew from 600 million in March of last year to 5 billion in May 2025. So for years, tokenization was talked about but not acted at scale. But what changed last year, and what actually convinced these traditional fund managers to make the move on chain?
I think the answer is BlackRock, right? So they, candidly, again, in my perspective, altered the trajectory of Securitize themselves, right? They participated in the last round that we had to raise, or that we raised, excuse me, and again went through the diligence, survived the diligence. They felt comfortable. There's actually a podcast clip floating around today, May 1st, on X about BlackRock seeing something different in Securitize as a tokenization platform versus the others. And that was really about being compliance first, regulated first as our stance, right? So I always say we don't do cute, we do black and white, right? We're dealing with securities, making digital asset securities, nothing more, nothing less. So when BlackRock went ahead and said we're going to work with Securitize, launch a net new fund, net new product in BIDL, and tokenize the whole thing, that I think was the shot across the bow for the rest of the industry to say, hey, we can go in as well. The comment, and I forget which prospect I was talking to about this, and they were, again, most people come in very curious about, explain the BlackRock relationship. How did that work? How does this work now? What are we not asking you? Like, please help us make the business case internally. And the comment from this manager was, you know, BlackRock can afford to be early to the party because, again, we've been around for 7 years, and only the last several years of Securitize's existence has been that hockey stick trajectory, right? We just started going parabolic on the back of things like BlackRock, then Apollo, then Hamilton Lane, et cetera. So they went in. It gave everyone else comfort to say if they're willing to, and if Securitize has survived that diligence, right, they're going to survive our process as well. The other comment, though, was that BlackRock, because of its sheer size, can afford to be early to the party. The flip side of that, though, is they can afford to be early to the party. They are early to the party. They can also take over the party, right? So, so that is, I think, the impetus for other managers to say, we can do it now, right? There is clearly a compliant, regulated path forward to do this, and we should, if we want to maintain, again, relevance with investors, but also competitiveness with large institutional asset managers, right? So across my inbox, my colleagues' inboxes that deal with managers and issuers of product, right? They all want to be fast follows. This space, much like every other space, there is always that concern. This is a really great idea. We really love what you're doing. We're not sure if we want to be your first customer. We already have our first customer. We have our first customer at $2.5 billion in AUM, which again, versus the rest of the world, still small, but compelling enough to really push other issuers forward. So that's been the big driver and the big success factor for us.
I want to spend some more time on the fund admin side. So in April of last year, Securitas acquired MG Stover's fund admin business, making Securitize Fund Services now the new entity, one of the world's largest or the world's largest digital asset fund administrator, now servicing more than 30 billion in assets across 750 products. And I think that coincides around the time that BlackRock became a customer of Securitize. Can you walk us through what Securitize Fund Services actually does for its fund clients and how that MG Stover acquisition? I also know MG Stover, they built a crypto fund platform called Otto. How those built into the end-to-end service you now offer at SFS, which is Securitize Fund Services.
Absolutely. So when I think about fund administration and the way Securitize has been built, so it's really, largely by acquisition, right? So we acquired a transfer agent. We used that to create and get approval for the digital transfer agent. So the blockchain is the system of record, the source of truth from a cap table perspective, right? From issuing security tokens, right? From issuing actual fund shares on chain. The original concept that Carlos had was that we needed to work with fund administrators that really understand the digital asset space. So the first acquisition actually occurred at the end of 2024 with Theorem Fund Services, which was probably the second or third fund administrator launched in the late 20 teens. We'll call it smaller than MG Stover, certainly, right? So we acquired Theorem Fund Services, launched Securitized Fund Services, then had the opportunity to acquire MG Stover shortly thereafter. MG Stover launched in 2014, arguably the first digital asset focused fund administrator, right? So as back in that day, right, it was Bitcoin only. So as funds and the concept of private funds were really being attached to crypto at the time of Bitcoin and Ethereum, right? We started seeing fund managers getting into this space. So they have ideally some kind of traditional buy side background, sell side background, they get into this. Where that works inside of Securitize, then going back to the concept of us being the only fully vertically integrated capital markets infrastructure, is that you, the manager, you, the emerging manager, needs all of the things that we offer, right, across X fund formation. So you need a lawyer externally to build the documentation, right? We have fund administration, we have KYC AML for investors, so investor onboarding, investor servicing. We have the transfer agent and the digital transfer agent that maintains, again, a record of who owns what, when, and where. Right, and then we have the DeFi team that sits inside, but really helps drive adoption and use of the tokenized assets. The critical sort of distinction or the piece that can be missed is that I don't want to tokenize every one of our fund managers, at least just yet, right? A lot of products don't necessarily make sense from a tokenization perspective right now because there is not a DeFi use case for those funds. And I talked to Carlos about this. His own venture fund is tokenized on our platform. It's not successful because it's tokenized. I tell every manager, you will not be successful just because you have a tokenized fund offering. Like that in and of itself is not the critical success factor, right? When an investor looks at the paper version of Apollo Private Credit and the tokenized version of Apollo Private Credit, the reason why they would want the tokenized version is because you can do stuff with it more easily than the paper version, right? You can make more money with your money. And so the investors go through our process rather than just calling up their broker because they see that opportunity and they want to take advantage of that opportunity. So 200 managers, 700 plus fund strategies across liquid hedge to venture, PE, fund of funds. Relatively speaking, that can be a standalone business, right? And that's what we do for all those fund managers and all those types of products that they offer. Slowly but surely, we will tokenize, the players as they become, if we see a use case on chain, and vice versa. Some of my pipeline comes in from existing managers that want us to administer the tokenized share class or the tokenized feeder fund just because the workflows are more seamless because all the data is in the back end underneath the Securitize umbrella. And then again, it's confusing if you're a crypto native. We're adding more utility to a security token because the data on the back end is more seamless. And so you have, intraday or same day liquidity in and out of the tokenized product. All those things are much more easily accomplished when Securitize, the umbrella, is administering the fund and servicing the product.
Before we continue, let's take a quick commercial break from our sponsor. If you're serious about running your business using crypto, you need tools built for crypto. One of my favorite apps, and yes, one that I use multiple times a month, is Request Finance. This app has been a game changer in how I invoice my clients and receive stable coins and crypto directly in my wallet. But hey, there's so much more to it. Request Finance is the all-in-one platform for crypto operations. Accounts payable, accounts receivable, expenses, and even accounting. Plus, they've got a killer multi-pay off-ramp to over 190 countries, meaning you can pay someone with crypto and they get fiat in their bank account. Request Finance connects to over 20 blockchain networks, including Ethereum, Solana, Base, Arbitrum, Near, and more. Here are some features that I love. Batch payments using your preferred wallet of choice, a single dashboard to track all invoices with real-time updates. All invoices contain the transaction hash for easy audits. But hey, don't take my word for it. Try it out for yourself. Head over to requestfinance/partners/theaccountantquits and get 2 months for free with all the pro account features. Join 3,000 finance leaders today using Request Finance and make crypto operations simpler, compliant, and less stressful. Now, I want to go through a very exciting news that happened a few weeks ago only. So, the New York Stock Exchange announced a memorandum of understanding with Securitize to collaborate on the infrastructure for making securities tokenized on public blockchain. So, congrats on this huge announcement, but yeah, let's drill down into the details a bit of this announcement. I'm going to read what that announcement said. It named Securitize as the first digital transfer agent eligible to mint blockchain native securities for corporate and ETF issuers on the New York Stock Exchange upcoming digital trading platform. My first question is, what is actually a digital transfer agent? You did mention it in your previous answer. And what does that actually mean in practice for the securities traded on the New York Stock Exchange?
Sure. So I always like to caution, tempering expectations, right? So the very specific wording that our press release mentioned, it's a MOU. So I say it's better than an announcement of an announcement, right? If you're on crypto Twitter, there's always this world of I'm about to say something really big, tune in and watch next week, right? It's better than that. But we're obviously not in production, right? This thing is not live yet, and the NYSE is going to move. The biggest compliment I could give teams like that is they're moving as fast as they can, just given their size and their infrastructure and on some level corporate inertia as well. What the MOU does state, though, like you said, right, we are going to be the first digital transfer agent as part of their NYSE affiliated digital trading platform for tokenized stock. So first part, a transfer agent, very traditional concept. I like to think of it as, again, an analog oracle of, who owns what, when, and where. So it's really a cap table, right? So traditional TAs are the ones that say Umar has, 100 shares of NVIDIA as of May 1st, a dividend is about to occur or there's a voting right. That transfer agent is the one that records ownership and really your physical address, also just mail out statements or things of that nature, right? If they need to reach the underlying asset holder or the investor. Digital TA is the exact same thing. We do operate one of the first, if not the first, digital transfer agent. It's SEC registered, approved, regulated, and the SEC, says, okay, we approve this concept, and the concept being traditional TA operates on an Oracle database, SQL database, what have you, right? Now we are leveraging public blockchains as the source of truth, right? So the actual public ledger says this wallet address tied to you, right? And that part is not public, right? Tied to, Duke Kim, to Omar, et cetera, holds these assets as of this date and time. The NYSE MOU and that announcement then says, hey, we are going to be the first digital TA to participate, to be connected to the NYSE trading platform. So we are then also the design partner in the rest of these workflows. So when Securitize posted it off on their social channels, when I posted it on mine, right, there's obviously a lot of comments underneath that of just what does it look like? At the end of the day, how does it actually work? To be honest, we're still figuring some of those things out, right? Which is the point of being a design partner. I think the kudos we can give to our team is that they chose us because again, they've seen that we are compliance first, regulation first. We've done this with real asset managers at scale. So, we're the best positioned to bring a really useful thing to market. I think what's more powerful is the announcement, or what synergistically powerful with the NYSE announcement is the announcement yesterday where we are partnered with Computershare, which is, I think, the largest transfer agent in the ecosystem, supporting about 60% of the S&P 500. So they are the traditional paper transfer agent for Apple, for Disney, for Nvidia and Tesla, right? So when you have those two things combined, right, now you think about when providers and issuers think about tokenization of their securities, one of the concerns is what do I have to replace from my existing infrastructure stack? Should I replace something from my existing infrastructure stack? That announcement gives, I think, those public equity issuers comfort and clarity in saying you don't have to rip up your contract with Computershare. There's no change there. There's no risk of relationship there. We are simply partnered with Computershare to offer the digital version of those securities. You don't have to rip and replace. It's actually complementary, and you can offer both. The easy concept I think about it is, let's say, and everyone is, again, this is neither public nor private information, everyone's chasing after SpaceX for their IPO, right? Every digital asset exchange out there wants to be able to trade tokenized shares of SpaceX when that thing IPOs, right? Let's say the IPO, the managers at the traditional investment banks are saying we're going to issue 100 million shares. Well, what you could do, and you can do this with an existing Tesla as it exists now, right? Again, not replacing your traditional transfer agent, working together. So we are the co-TA, the sub-TA for the entity and for the issuer. We identify with the issuer 20 million shares that are sitting at DTC. We pull them out of circulation, right? So now the existing paper shares go from 100 million to 80 million, and then Securitize and the Securitized digital transfer agent will mint 20 million tokenized equity shares. So net, you still have 100 million shares running around. The two are completely fungible, right? They're both securities, and investors can be able to jump back in and out of either version that they would like based on their whims or based on the use case, right? So I can, again, foresee a world in which we have worked with Computershare, worked with NYSE to, again, tokenize Tesla shares. Great. So instead of Tesla shares sitting in your brokerage account at Fidelity and you can't really do too much with it, maybe these younger investors, these more forward-thinking investors say, well, I have all those shares sitting there and they do nothing for me. I can convert them into tokenized shares, same rights, same governance, same everything, right? Same economic interest because they're simply shares sitting in my MetaMask wallet or my Exodus wallet. But now I can do something in DeFi with them, right? I can borrow and lend more easily against those assets. So again, I can make more money with my money. I want to use the tokenized version of that. So I think that those two announcements in combination have a really powerful synergistic effect. Then, and I was writing about this on LinkedIn the other afternoon, right? Then you have the DeFi team alongside of us, internal to Securitize, right? Making sure that there are really great compliant places and compliant workflows that are implemented so that investors holding tokenized securities, tokenized equity, can do more stuff with their stuff.
I'm just trying to think in terms of proving ownership of a tokenized security, under which token standard would that be? That's a ERC20 token, right?
Correct. Everything from world starts, or the journey from us starts with an ERC20. So it's very simple. The contract is pretty lightweight. Our technical team has been building, this DS protocol, their own vault infrastructure, things of that nature. So, but it's meant to be pretty easy to understand, and it's meant to be pretty lightweight for us as the token issuer alongside the actual issuer.
Now, At Securitize, you currently issue tokenized assets across multiple blockchains. Biddle launched on Ethereum, Hamilton Lane Scope Fund expanded to Ethereum, and Optimism was as well. And you've been expanding to other chains like, I believe, Solana, for example. Which blockchains does Securitize currently support? And my question is this, like, who determines which chain this asset will be deployed on?
So right. So again, everything starts as an ERC20 on ETH, right? And then it's really up to the manager. So philosophically, what we've really been building towards are or building on are public blockchains, right? That's part of our DNA. So again, internally, we have the conversations about Canton, we have the conversations about other permissioned or private blockchains or private permission blockchains, et cetera. We can, right? I don't think we've either seen the need or built the business case internally or externally with an issuer that wants to be on those blockchains yet. So not meant to be a tribal, fight here on this pod, but where we have been, we support about, I think, a dozen and a half public blockchains, and we'll build to more just based on where we see activity. From where, who decides what to deploy on, we leave that to the manager, right? So oftentimes they come to us and say, hey, where should we deploy? And we'll say, well, it's truly up to you, right? We are on some level a purely technical solution. We just give you the option. It's basically just a menu when you onboard with us. Where do you want to deploy? You can certainly deploy on more blockchains, right? We have interoperability. We use Redstone and Wormhole, right? We can do all those things with the assets. The question just comes down to operational control, operational risk, TVL on those chains. Does your product make sense on that chain, right? Is there going to be a natural buyer base on some of the less trafficked L1s and L2s? Right. So again, not a value conversation, not, not neither good nor bad, but simply we leave that up to the manager. We can certainly build the tech for it, and we'll build to what we need to build to.
Got it. Next, I want to spend some time on the tech stack for these tokenized assets. So basically for the finance people listening to us, how do they actually manage tokenized securities, funds, or other RWAs on their balance sheet? You've spent time at Legible, a crypto subledger, before joining Securitize, so you actually understand this problem from both sides. If equities and funds are now settling on-chain 24/7, the infrastructure for accounting, of course, has to evolve with it. Does every company holding tokenized securities now need a crypto subledger in their stack the same way, the Web3 companies today use tools like Crypto or Tress?
I think so, right? So when you think about even from a fund perspective and fund administration, I always joke if you and I are just smashing a button on Coinbase, you may not need a digital asset focused fund administrator. And SFS, Securitized Fund Services, is really the only pure play digital asset focused fund admin out there. You can probably, maybe, I wouldn't recommend it, but you can certainly go to a traditional administrator and they can take a CSV extract of our Coinbase activity and say we could administer, do accounting, do all of the books and records on the back of that. As transaction volumes or complexity of the strategy increases, then I would make the strong argument that you do need a tool like a Cryptio or a Tress, right? So that you have both traditional view using general ledger platforms or ERP platforms, and we're really meant to be we being the crypto subledger providers that are out there, the subledger, right? They're the sub GL, they're just the crypto version or just the crypto activity aggregated, standardized, normalized, and then plugged into or rolled up into more traditional general ledger software. So where we fit is from a tech provider perspective, certainly, but also just education of just understanding what all you're doing. So Securitize leverages a couple of tools like Cryptio, right? Securitize Fund Services uses different tools just because we are somewhat different businesses, different use case. So we'll leverage tools like an auto and trust finance for the crypto community because of the volume or the complexity of what some of these managers are doing. And there are certainly other tools as well that can also be leveraged by the fund manager themselves, acting like a shadow ledger capability.
All right. And is there any other tools that comes to mind in the tech stack of what those, let's say, institutional players now issuing their tokenized securities funds would actually need. We mentioned custody before, so platforms like Fireblocks, Anchorage, BitGo. Does any other tool come to mind?
The only other one that comes to mind more from a trading perspective than it would be from an issuance perspective, because from an issuance and valuation, I'm doing your NAVs, right? So I'm giving you the actual compliant NAV calculation, the price for those, tokenized shares. When you are a fund trading in liquid assets or illiquids, I guess, as well, right? Then you also might think about GAAP and IFRS compliant pricing and data sources. So this has been a problem in the fund space for really since digital asset funds were a thing. So when I think of reviewing PPMs and offering memorandums from the late 20 teens for my fund admin clients, everyone would simply say, well, we're just going to use, you know, coin market cap or coin cap. Back there was, forgetting the name now, is a shapeshift product, and we'll just say because the markets are 24/7, let's just use midnight UTC, and that's just the best price we can capture. That was fine. It wasn't an amazing experience for anyone, but we've seen as the space has matured. I remember when Bitwise was really starting their petition for ETF product, right? So in the late 20 teens, they created Bitwise Real 10. And so it was a very deep, I remember for some reason loving reading this 200-page PDF that they had presented in front of the SEC and the PCAOB to say this is how we are actually going to give you a true gap aligned, IFRS aligned market price for digital assets. So because, Bitcoin trades on every digital asset exchange out there, what's the primary market, right? Because that's what the traditional Wall Street, traditional buy side requires. There isn't a primary market. It isn't Coinbase or Gemini or Kraken necessarily. So they built an infrastructure to weed out the bad exchanges, the bad data, the wash trading that were just, exchanges trying to boost up their or optics and their metrics. Created that. When I was at Luca, we built a product, and now there are a number of other providers out there that have defensible pricing mechanisms and sources, right? This S&P is in the game, right? Like they have now a way to say at 4 p.m. or whenever your documents say you need to close the books and strike an end of day price, you have a defensible calculation methodology to derive that price or to identify the primary market and give you that price at a close. So I think for managers in particular, that can be an add-on or another thing to be aware of and to make sure that you address properly so that you do have, again, compliant pricing on your books. The other piece, and it's been a little while since I've thought about it, right, from an accounting perspective, was I think the right way to think about it is the repeal of SAB 121, where digital assets held on balance sheet were just liabilities, right? So there were in the early 20s concerns about issuers, about DATs couldn't have been a thing in the early 20s because all of the crypto that they accumulated on their balance sheet would be viewed as a liability rather than an asset, right? And or you have this thing on your balance sheet, but because there's not a clear way to value them, you have $1 billion of Bitcoin, but we'll only credit you from an asset perspective 900 million, right? Or 850 million, whatever the haircut is. Now we have pricing tools and data tools that can allow the full value and appreciation of those assets held on balance sheet.
Yeah, that's a great point you mentioned because you do have to determine this active market where you have the greatest volume and level of activity, where your crypto asset is basically trading. And let's say with a tool like Auto, what pricing source would you use? Because I understand like subledgers, they are actually using sources like CoinMarketCap, Crypto Compare, or CoinGecko.
So still depends on the manager themselves, right, in terms of their tolerance. I wouldn't even think about like from an operational risk, but if they're investors and whatever their compliance requirements are such that coin market cap is sufficient, then it's sufficient, right? The subledger tools that we use that are out there in the market, they're really just data aggregators. So if the manager themselves says, hey, we really need to use digital asset research, we really need to use Kaiko for this thing, or Amber, whoever, no preference on our side, it's a data source, right? Sometimes the conversation is who pays for that data source, right? Is it the administrator, the subledger tech? Is it the manager? But broadly speaking, it's just another data point and up to what the manager needs and what their documentation requires. So the tools that we use are pretty flexible there. And then again, we just configure based on manager preference. Some managers are completely happy just saying, hey, we do a majority of our trading on Kraken. We'll use the Kraken price for XBT at 4 p.m. Eastern as our snapshot. That's fine as well. So it's more about configuration. We're, again, we are a tech provider at the end of the day.
Very clear. All right, so I want to move on to a different topic now, which is on-chain vaults. So these on-chain vaults have become an increasingly popular way for institutions to earn yield on-chain. I was looking at DeFi Llama. The TVL across risk curators is currently sitting around 6 billion right now. Last month, Securitize Fund Services, the fund admin arm that we just went through, they announced a partnership with Upshift, an institutional grade on-chain yield platform to deliver independent, audit-ready reporting infrastructure for on-chain vaults. Can you walk us through Securitize involvement with on-chain vaults, what that looks like in practice, and what this partnership with Upshift actually means?
Sure. So I love vaults, right? This narrative has really taken a hold over the last 6 months, in terms of a TVL perspective, like you had mentioned, right? A lot of traditional managers and digital asset managers are either deploying into these vaults or starting to curate and create them themselves, right? You saw Bitwise actually launching on-chain solutions. So one of the leading digital asset, kind of traditional looking managers, right? Also getting into this space in a very serious way. Apollo getting into this space in a very serious way. So the way I think of vaults broadly is on-chain hedge fund, right? It's a smart contract created to identify the best yield opportunity for the assets that it's been entrusted with, right? So it's a stable coin pair, ETH and a stable coin, whatever the things are, then that contract says, I will go identify the best place to make money with your money, right? In a secure, transparent way. So the concept is fund managers that are my clients on the SFS side, right? They are also looking at curating vaults as another way for investor distribution, getting access to people, getting access to capital, right? And capturing fees on that, leveraging their strategies to make money with your money, right? They're also deploying as an LP into that vault as well. So the concept first was I just have to get in front and be able to support my client base. And then we took that a step farther and saying, well, if these vaults look like funds to some degree, then they might want independent reporting as well from a performance perspective, right? So don't just trust the platform. It's not a trust me bro situation, right? These are dealing with real amounts of institutional capital. They may want external reporting done on that smart contract on that vault. You have some platforms that have built a little bit of really cool tech, not even a little bit, sorry, built really cool tech when you think of something like Accountable, right? It's a vault curation platform that is also accountable, right? So that it can give you a portfolio level NAV, right? Which is really, number of tokens that are locked or pledged in a vault times a price at a given moment in time, right? So some platforms can give you block by block or every 6 seconds, right? Visibility and a price of risk. What it doesn't do, obviously, is give you fund level NAV or vault level NAV based on where the assets are at any given point in time. But they also don't output data that is audit and tax ready. One interesting thing that I've seen is the Big Four, KPMG's tax team in New York. So the US KPMG team writing on LinkedIn, writing publicly about the tax implication of vault curation and vault liquidity provision, right? Still big questions out there, but they're getting ahead of that by throwing some of those questions out there and saying, these are the things that we all need to come to consensus on, come to agreement on how we're going to navigate the space. So I said, well, now there is a real need for independent data in a format that is digestible by audit and tax professionals, right? It's not enough just to say 100 tokens are in this wallet, they're at this price. That's fine. That's important information, absolutely, right? That is not sufficient information to be audit and tax compliant. So that's where we came up with the idea of going out to the vault platforms themselves and saying, hey, can we work together to provide you that extra layer of independence in reporting, but also that reporting is going to be very useful in helping you capture institutional capital and institutional allocator, or institutional capital and institutional vault curators, so that they can leverage your platform to receive institutional capital.
And those reports would eventually be publicly viewable, right?
Some of them can be, right? When you think about the vault level reporting, absolutely, right? They should be reportable. So then it's simply us reading contract addresses, wallet addresses, doing the formatting, normalization, et cetera, and then being able to publish on some periodic basis back to that vault platform for external revelation. LP level, again, it's really all on chain. We're still figuring that out at the level that I'm in a vault, I'm participating in a vault. Should that information be fully publicly visible? And again, it's really a formatting exercise more than anything. Like, you have my wallet address, you can see what I've done, but is it in a way that, your tax person versus my tax person can use? That's to be determined.
Duke, this conversation is fascinating, but I'm saying we're soon going to be hitting the 1 hour mark, and I want to be respectful of your time. Maybe there's a last topic that I want to go through, which is on the future of tokenized assets. Securitize slogan is to tokenize the world. Last month, you published a report with KeyRock. It's a 60-page report. I can share it in the show notes, and it's titled The 400 Trillion Future of Tokenized Assets. The core thesis is that tokenization solved issuance. Every major asset class like T-bills, equities, private credit, funds now has a representation on a public blockchain. But the report makes an important distinction. Putting an asset on chain is not the same as making it trade, compose, and settle like a financial instrument, meaning the issuance era it delivered with Securitize in the driving seat. Now the distribution is the next phase. As we close out today, where are we actually in this distribution era, and what still needs to happen in the infrastructure before, let's say, more institutional capital can come on chain?
It is the, yeah, multi-trillion dollar question, right? So we'd always say, look, if everything on our side starts as an ERC20, tokenization is relatively simple from that perspective, right? You and I can flip our phone open and tokenize whatever we want, or create a token, right? Whether or not it's compliant is a different question, but tokenization in and of itself is just the first domino to fall. Distribution is the challenge, but I think the roadblock to distribution is twofold, right? So one, going back to the concept of custody, right? At the issuer level, if they actually need to custody digital assets, do they get comfortable? How do they get comfortable? What are the operational controls and paperwork they need to update to support those assets? From an investor perspective, same thing, right? You and I have probably an ungodly number of MetaMask wallets across all of our computers, but most investors still don't, right? And you can't just call up your Fidelity broker and say, I need you to custody or hold my digital token, right? My tokenized assets. The retail level infrastructure is not there yet. I think that's a piece of it. The other side, then, there's this bit of a chicken and egg, and this is going to go to a longer conversation, is just around the current on-chain investor base with the current on-chain tokenized assets, right? So what we have built, what our competitors have built and created so far, money market funds, AAA CLO product, low, no duration type product with corresponding, yield profiles. As more investors come on chain and there's stickier capital, right, we can create higher yielding opportunities because higher yielding assets will come on chain, and investors aren't always worried as soon as price goes down a little bit that I need to jump out, right? If I were to jump into a private credit fund, I'd be more than happy with, quarterly redemption window and illiquidity because my capital is going to be stickier, and I'm not here for, a quick trade in 2 days. I want to be here for in this product for 3 years. So, but those two are kind of the same problems together, right? So it's who's on chain, what's on chain, right? We need to kind of bring those together in lockstep. So distribution broadly, though, is that big challenge. We try to bring stuff that is going to be appealing to investors. So we work with the great managers. There's a specific yield profile. We identify with our DeFi and our ecosystem team the use cases for those assets, making them more useful. Why does an investor want a tokenized versus a paper product? Right? Putting all those together has, I think, been the not even the secret to our success, it's the recipe to success.
And I could also not finish the podcast without mentioning that Securitas will be going public, right, very soon. What does this change for, or what does it mean for Securitize and more broader the tokenization industry?
Let me answer the second part first. I think it's a really great credibility point for all of us in this ecosystem, right? Whenever these larger crypto companies go public, Coinbase, BitGo, us, it's a great shot of legitimacy and credibility in the ecosystem. Everyone always jokes when, your company goes public, your parents are like, "You work for Bitcoin. This is really neat. Like you're doing something real now. You work for a real company." So there's that part. I personally am excited that we're being born in somewhat of a bear market here as well, right? The revenue multiples, the metrics are reasonable, right? We're not in that kind of DeFi bubble boom in the early 20s where everything was a unicorn with $10 million in revenue, right? We have real revenue, reasonable metrics and multiples. Very excited. Personally, I still have to work tomorrow, right? We go public. I'm still gonna, it's a liquidity event. I still have to work. But on the flip side of that, though, with I guess the SPAC funding and the pipe that we have, we'll have, I believe, 400 and this is public, right? $460 million in cash, capital treasury, right? So that we can continue to build, we can withstand bear market turbulence. We can acquire what we need to acquire if we need to acquire something to continue building what we really see as a tokenized future. So it's great for the ecosystem, obviously great for us, great for our team. And there are people, inside of the company that have been here day one, right? They have just poured blood, sweat, and tears into the company, into the platform, and we've all shared the same vision of tokenization of the world.
Very exciting. I mean, it's very exciting time to be a part of Securitize. And because this podcast is listened by accounting and finance professionals, are you guys hiring right now in the accounting and finance department and maybe also remotely?
We are always hiring across Securitized Fund Services, right? So we are, again, you can view us as a standalone business. So there's always that kind of natural churn in the ecosystem. So we're always looking specifically, we have both a closed end fund account, like a private equity fund account and role open. There's always need for more liquid people as well. We are a remote company, largely US and Canada domiciled. And so that's broadly where we've been trying to fish so far. So if you are interested, please reach out to me. I'm very easy to find across LinkedIn and X.
Perfect. Thanks for sharing, Duke. Duke, this has been a fascinating conversation as we close out the episode for today. Has there been anything else that you wanted to mention to the listeners that we didn't, or how would you summarize the episode for today? The title was Tokenization of Real World Assets.
So I think the big takeaway is that regardless of where you sit as an audience member here, right, is that there are real companies building real infrastructure, regulated fashion, compliant fashion, working with real issuers, right? So none of this now I think we've moved beyond proof of concept. We've moved beyond two guys in a garage with a dream, right? We're actually bringing this to light at scale, still broadly small across, the actual market. But when you think about, I think Benchmark Securities had initiated research on our upcoming ticker and when we go public, and their comment was this team just getting 1% of the overall market tokenized dramatically shifts our profile. And so I'm not here to pitch our stock or anything like that, but you really think about how much more game there is to play, right? And so us, some of our worthy competitors, people alongside of us in the ecosystem, really building to a future that is becoming more clear, right? Becoming a real thing and really starting to crystallize. It's not just a pipe dream anymore. Like it's a thing that we can actually march towards. We have the path forward and we have the TAM that has now been exposed for us to actually capture.
Perfect. Thanks for sharing. I'm not sure if you saw this in the doc that I sent you as well, but there's actually a last question that I ask my guests before they leave is, do you have a favorite quote or like a maxim that you live by?
A lot of favorite quotes. The new maxim for me has been 30 minutes smarter. And the way I think about that, when I jumped into crypto, I always wanted to learn stuff, right? I didn't want to just smash buttons really quickly as a sell side trader. I wanted to learn something every day. So all the things that we covered today, some of those are in my actual day-to-day work. Some of those are just because I work for Securitize. Some of those are just because I'm in the DeFi ecosystem or broadly digital assets. I'm not a brilliant guy. I'm barely a smart guy, but I'm a guy that will spend 30 minutes every day reading on something and then also taking away from conversations with you, conversations with other people, and bringing that to the next person in my circle, right? So my stance is always not a genius, but I've invested 30 minutes and I'm 30 minutes smarter than you. And hopefully you have this conversation, you're listening to this podcast, you get 30 minutes smarter and you get to talk to somebody else. So that has been my maxim over the last year or so in this space where it's really started to come together. It's I'm not that smart. I've been in the space for a long time, 30 minutes smarter than the next guy.
Yeah, and 30 minutes every day compounds over 1 year, over years, and it actually makes us have a brilliant conversation today. Thanks a lot for joining us today, Duke. If people want to reach out to you on socials, where should they go?
So I'm what is it? Degenerate on X. So, but I'm the same handle really across all social platforms. So the Duke Kim across LinkedIn, X. You can even follow my Instagram if you'd like. But that's really where I am. And so I do like to share what I see in capital markets, what I see in fund administration, what I see on trending memes as well. So I like to bring all that together and be a human being in the space.
Perfect. I'll be sharing those. Thanks a lot again for joining us today, Duke. And I'll probably see you at the next crypto conference, though that will not be consensus next week, the one after.
I'm looking forward to, I think we're going to align at CoinAlts in October, so in San Francisco. Looking forward to that, sir.